Which interest rate is safer for your debt in inflation? Imagine you're looking at your monthly bills and wondering how inflation might change what you owe in the future. When inflation rises, it affects how much your debt costs over time. So, which interest rate keeps your finances safer? That's what we're here to find out. When inflation is high, a fixed interest rate is usually the safer choice for your debt. This is because a fixed rate stays the same for the entire loan period. Whether inflation jumps or stays steady, your payments won't change. That means you can plan your budget without surprises. If you have a fixed-rate mortgage, your monthly payment stays the same for 15 or 30 years. This stability helps you avoid payment increases that can happen with inflation. On the other hand, variable interest rates change with market interest rates. When inflation goes up, central banks often raise interest rates to slow inflation. As a result, loans with variable rates will likely have higher payments over time. This can make it harder for households to keep up with their debt, especially if wages don't increase as fast as interest rates. Rising payments can strain household budgets and make debt more expensive overall. Inflation also reduces the real value of money. If you have a fixed-rate loan, the amount you owe stays the same, but inflation makes that amount easier to pay back because prices and wages tend to rise. So, in an inflationary environment, fixed interest rates help you pay less in real terms over time. Meanwhile, variable rates can increase your debt costs as market rates climb, making it more costly to borrow money. Central banks usually raise interest rates to fight inflation. This means that if you have a variable rate loan, your payments could increase as rates go up. Fixed-rate loans lock in your rate at the start, giving you peace of mind. While fixed rates might be a little higher initially, they protect you from future rate hikes and payment shocks. For households, choosing a fixed interest rate during times of rising inflation offers more security. It helps keep monthly payments predictable and shields you from sudden increases. Variable rates might seem tempting because they can start lower, but they carry the risk of becoming more expensive if inflation continues to rise. So, if you want to keep your debt manageable and avoid surprises, fixed interest rates are generally the safer bet during inflation periods.